I hope y'all got your questions on deck. Raise your hand if you want to speak, and I'll call the name that I see on the screen. I ain't got no fancy slides today. We just
I gotta hit the thing to raise my hand. I got it.
yeah, it say raise hand.
Well, I'm on my phone. The thing I gotta hit more.
Yeah, you gotta look at the little hit more and then hit raise hand if you want to raise your hand, and then I'll tell you to unmute and talk. I got some. I got a couple questions for some gun shy people. Hopefully they tune in to hear me answer these questions. But if not, some people that's on here may have these same questions. So it's it's 3:01. So I'm gonna go ahead and run through it. I'm run through these questions that I got on here, and then if anybody got some questions in addition to these, we'll go through those. We got about 30 minutes before it cut me off, and we gonna go from 9 to whenever we finish answering questions within that 30 minutes. Y'all ready? Chicken Novi. Are you ready? Yeah. Are you ready?
Yes, we are. I ready.
All right. These questions ain't in no. I hear echo. I wonder if it's coming through my phone. Because for some reason I can't turn it all the way down when I have my Zoom. I'm just gonna close the Zoom out because I ain't doing no slides, so I don't need to see if I'm looking right. So yeah, no particular order on these questions, but the first one I'm gonna answer is can I pay you to do this for me? Everybody who been tuning in for them last 6, 7, 8 weeks we've been doing this, I am not a financial advisor. I am not a fiduciary. Investing involves considerable risk. Anything I say should not be considered financial advice. You should always consult a financial advisor before making any investments. Do your own research. They ain't the exact order that they be in because I used to be reading them, but y'all already know. I am not a financial advisor. I'm not a fiduciary. I'm just sharing what I learned along my way. So that's the answer. That ain't the most important question, but I just wanted to start with that one because that's one of the questions I got. Can I pay you to do this for me? No, you cannot, but you can for free 99. Go back and look at the videos that I did over the 6 weeks time that we got together doing this every Sunday at 3:00. Look at those. Go to the Come Up series. Look at the starter pack and all the other videos. Go to EYL Earn Your Leisure YouTube page and look at all the Market Mondays. You can get all the information you need for the free 99 to change your life. All right. Next question. How to find a company to invest in. The easiest way, I call it the cheat code. If you want to figure out what you want to invest in, you can't think. If you want to do individual companies, I prefer investing in ETFs, which is exchange traded funds, because exchange traded funds is like a bucket of companies, is a group of companies that you invested into this one ETF, but you putting money into all of those companies, and that help diversify your portfolio by just investing in one ETF instead of investing in one company. And that's my way of choice. But the cheat code to find a company to invest in is to go look up the ETFs and look at their top 10 holdings. Their top 10 holdings going to be probably the most successful, for lack of a better term, companies that's in the ETF. And then you can say, hey, I like tech. Matter of fact, let me share my screen. I did this before in one of the earlier episodes. I can't remember which one it was, but go to a site called FinViz. Let me pull it up. Let me share my screen, and then I'm gonna pull up FinViz. Screen. Why do I see? Okay, share. Do y'all see my Google screen? Make sure I close my Zoom out right here.
Yeah, I see it.
All right, so FinViz. Y'all remember this if y'all was on there for one of them weeks. Finviz.com. Come to FinViz, this little green and red thing over here with my mouse moving around. It's got like a little ad dude on a motorcycle up under it. That's called the map. if you go to the map, you hit the map, get out of here, ad. They got 1 million ads on this thing. And when you go to the map, it pull up a big version of what you was looking at. Over here on the left-hand side, under the menus over here on the left-hand side, say map filters. You come down to exchange traded funds. You even got to come to exchange traded funds if you want to, because you can see the companies right here. But if you want to see like the top 10 holdings of the ETFs, right? Boom, you come to ETFs, just say you like financials. Now, the easiest way to do it, most people that invest with hedge funds and stuff, their benchmark is the S&P 500. So if you want, so the easy way to do it is look at the S&P 500 ETFs. You know them because they all start with XL something. You got XLF, that's the financial ETF. You got XLK, that's the technology ETF. You got XLE, that's the energy ETF. You got XLI, industrial, XLY, consumer discretionary. They call them consumer cyclicals, but it's discretionary. XLB, which is like basic materials. Y'all get the picture. It's XL something. So you come on here and you look at you like financials. You want to invest in a financial company. You come over here to XLF, right? You come to XLF and then you go look up XLF and figure out what their top 10 holdings are, right? You can even Google it. You can, like, if you got the CNBC app on your phone, on the phone, it shows it right on that first screen. On the computer, I can't figure out how to get to it on CBNC, but if you just type in top, get out of there, hit the wrong thing, pull the hit shift, top 10 holdings XLF, right? I'm doing XLF. Boom. You got JP Morgan. You got JP Morgan, Bank of America. Right there. JP, you got Berkshire Hathaway, JP Morgan, Bank of America, Wells Fargo. Those are the top 10 holdings in the finance. So you say, okay, I want to invest in finances. I don't know a company I want to look in. Boom. You look up the ETFs. You find the ETFs on FinViz. Figure out what sector you like. I like technology, I like financial, I like energy, I like consumers, discretionary, whatever. Go to the XL something, that's the S&P top. That's what most people shoot as they benchmark, the S&P different ETFs. And then you say, I like financials. Then you look up the top 10 for that. Okay, I want to invest in JP Morgan. Boom, there go they ticker symbol. I want to invest in Bank of America. Boom. That's a quick way to find a company to invest in when you don't know what to invest in. And then from the other videos, you know how to do your due diligence on that. Go to their investor relations page, look at their fundamentals. First, you want to go to their chart. Once you figure out I want to invest in it, look at their chart. If they chart going up and to the right, look at a 5-year time period, 5-year month, like change in your chart of choice. If it's Ally, if it's TD Ameritrade, if it's whatever, pull up that ticker symbol, set it to 5 years by months on the calendars. And if it's going up and to the right, okay, you know they're in an uptrend. Then you start doing your deep dive on the company. That's how you find a company to invest in. Are ETFs better than individuals companies? It's not that it's better. One is not better than the other. I just like ETFs for diversification easily. Like you see, if I invest in like XLF, you see I'm investing in this, the top 10, but it's in the top 10 comprises 54.49% of this ETF. So I'm spread out over these companies plus. I'm not sure how many in there. You can look it up on etf.com. etf.com. It'll tell you all the information about the different ETFs. Just put in the ticker symbol. But I'm invested in Berkshire Hathaway, JP Morgan, Bank of America, Wells Fargo, Citigroup. See, I'm diversified by investing in this one ETF. Whereas if I just go out there and invest in JP Morgan, I'm in JP Morgan. Then I'm in Bank of America. Then I'm in Citigroup. I got if JP Morgan doing bad today, my whole position doing bad. But if I'm invested in XLF, if BlackRock do bad today, Berkshire Hathaway may be doing good. So I'm still, it ain't hurting me as much. Am I going too fast for anybody? If I am, just say, yeah, you're going too fast.
Yeah, you're going too fast.
Okay. What did you got a question on is for what I said so far?
Okay, when you were saying like ETF, you're just saying that's because there's a cluster of companies under
particular type of ETF instead of investing in one? Can you just clear that up just a little bit?
Yeah, my preference is investing in ETFs because, like I said, if I like financials, we're gonna stick with financials today. If I like financials and I want to put money into JP Morgan, if I go out there and I put $5,000 into JP Morgan, if JP Morgan do bad that day, then I'm doing bad. No matter what. If they doing bad, I'm doing bad because all my money is in JP Morgan, right? But if I want exposure to JP Morgan, I can go put my money in XLF. And if JP Morgan does bad that day, then Berkshire Hathaway, Bank of America, and Wells Fargo, they may be doing great that day. So it's like I can still gain money even if JP Morgan doing bad that day because my money is diversified. So it's not it's just about, for me, it's about diversification is simpler by doing it through the ETFs. Whereas I don't want to go out and diversify myself by finding 10 different companies to put my money in.
Right. So I did understand the breakdown of it. It's just how I get to, before I break down, like choosing the ETF or XLF. That's where I got
FinViz. You come to FinViz and say, okay, I like financials. And then when you come to all of these under here, like on FinViz, you see it say XLF, KRE, FAS, KBE. All of those are different financial ETFs. Now, the XLF, that's just the one. It says financial select sectors, SPDR, SPDR funds. That's the S&P 500 ETF, and that's what most hedge funds and everybody, that's their benchmark. The S&P 500 is their benchmark, and they try to beat the S&P 500. That's that. If long as they beat the S&P 500, they got a job. And so the XLF is the one that belongs to the S&P 500. That's the S&P 500's ETF that they made for financials. So if you want to invest in financials, you come to FinViz and look up the financial ETFs. And you can pick any of these ETFs in here. I just prefer to stick with the ones that's made by the S&P 500 themselves. Did that clear anything up?
It did. It cleared a lot up. Thank you so much.
Okay, and it's the same thing if you like the old what they call them blue chip stocks, the true blue ones, and you want to invest in XLP, the consumer staples, like stuff like Coca-Cola and all that, where they at right here, consumer non-cyclicals, whatever these like the old tried and true companies. They ain't growing no more, they just slow and steady, stuff like Coke and Ford and all that. I think Ford in there, but yeah, they XLP. That ain't my thing because I like growth. I guess I'm a risky Roger. So because I like growth, I like, that's what I like. Let me see. Did I type that in right? Oh, I'm on Yahoo Finance. I should have did it in Google. But anyway, XLP. That's for the slow and steady stuff. How do I know when to buy? How do I know when to buy? That's you go through stock charts, stockcharts.com, and it'll show you like the seasonality. You come to stockcharts.com and you go up here where it says sharp chart and drop that down to seasonality. And then you put in, we're going to stick with XLF today. You can put in a regular company, but we're just sticking with XLF. And this right here show you over the past 5 years, the times when they most likely going to pull back. And it's January, February, March, April, May, June, July, August, September, October, November, December. And it shows you the months that is more than likely going to be pulling back based off history. Over the past 5 years, this is the likelihood, 6% chance that it's going to be up on an average 2.3%. 6% chance it'll be up on average 1%. 20% chance it's going to be down 4.8%. You know what I'm saying? It's like it give you the seasonality of it. So you wanna start planning on buying during them times during pullbacks. Like with financials, you want to be planning on buying in March. You want to be planning April, May. You want to be planning on buying around May. Anywhere June, May, June, July, August, September, October, August. That's just a flip up. that it'll be one of the things where it'll be a flip up around that time of the year. But those are the time, like you want to be investing 3, maybe 4 times a year when you buying your positions, putting your positions on, or if you don't have like a lot of money just to dump at one time, you can dollar cost average in. But personally, a dollar cost averaging in meaning you just put in a little bit of money every month or every pay period or how much time you got. But personally, I like to buy it on pullbacks. So you look at like the time frame when it's gonna be pulling back. That's when you're getting ready. Okay, I'm getting ready to invest around this time, and then you start watching the charts. You start watching the charts of it. Let me see if I can find a chart on here. I don't really use Yahoo Finance, so let me see if I can try. And once you, let me see if QQQ pull up some. Can I find full screen charts? Can I change this? How you change this? We're just gonna use QQQ. And we ain't gonna mess with on what's nice. So then you look here, up here at the top, everybody can see my thing while I'm moving around here. You don't want to buy up here, right? You see it came down with this pullback, boom. You want to buy around here. And then the way you can pick a spot that you want to buy, you can either use your indicators, you can use like a 20, like a 50-day moving average, a 200-day moving average. Those indicators you can use like the Bollinger Bands to let you know when it's getting low. You can use price channels to let you know when it's getting low, but you want to have a price point. Like when you look in here, you can see this area right here. Around this area was acting like support, because when I come there, it touched there, it came close to it, it came here, it touched there again. You know, it's acting as support. So once it starts getting around this area, you can say, okay, when it get around there, I want to be looking to buy. And then you use your move, and that's like using support as a spot to buy. Or you can use like your 72 or your 100-day moving average. When I let me see how to add indicators on here. Let's go to moving average. And then I'm gonna put in the 72-day moving average, right? Boom. You say when it hit my 72-day moving average, which would be at $317.89 at this time, boom, that's when I'm gonna buy. You know, that's the price you want to buy it. If you a 200-day moving average person, you say let me see, 200, put it to 200. You say when it get all the way down to $290.51 at this time frame, boom, that's when I'm gonna buy. And that's how you can figure. That's the time you figure out when to buy. You can do it by time, and you can do it by price. What seasonality, and you can do it by price. Those the way you can figure out when you want to buy. How to use put. Any questions on that before I go to the next question? I got 2 more questions. Yeah, I got 2 more questions that I got from gunshot folk. Okay, no questions. All right, how to use puts for defense. All right, and for those who don't know, puts is you for in the options world, because I trade options. So you buying a call when you saying you think this asset gonna go up. You buy a put when you think it's gonna go down. So how to use puts for defense? You look at the seasonality of it. We're looking at the seasonality of XLF right here, and you see typically in January, February, March, we already in March, leaving March, April, May. In May, it typically pull back. So in mid to late April, you're going to be looking to put in the way the come up series teach it, for every 5 call contracts that you own, you're going to be looking to put on 1 put during times of a pullback. So if you got 1 through 5 call contracts, you buy 1 put. If you got 6 through 10 call contracts, you buy 2 puts. So what you do for the XLF here, around the middle toward the end of April, when you see it, like using your let's see if we can put on like some Bollinger Bands. Let's use Bollinger Bands, right? 20 period moving average. So the Bollinger Bands, what this is, the middle line right there, that's the 20-day moving average. And then the top and the bottom is like the oversold and overbought ranges. So let's just say when it, see how it got close to the top of the Bollinger Band here, and then it pulled down to the bottom, went back to the 20-day, pulled back down to the bottom again. Let's just say this was like the middle of April right here. You up here toward the top of the Bollinger. If you get cooking hot around the top of the Bollinger Bands, and you know next month is typically going to be a pullback right around this area, you're going to be looking to buy a put that's like at least 3 months out. You want to do it roughly 3 months out. You don't want to put it way out at 6 months. You don't want to put it at 1 month. You buy a put 3 months out. So just say if it's June, July, August, September. If it's June, you'll buy a put that expires in September, and you will buy it for down here at this level of support, which you'll be, if you up here at 336.45, you will buy your put for a strike price of around $315. So you will buy a put 3 months away for a strike price around $315. And then when it start pulling back, if you got any short-term call positions, anything that's like 6 months to less than 9 months, you will want to go ahead and close them out right now on the call side, buy your puts, and while it pulls back over this next month, that put is going to be making money while it's going down. And the closer it get to this strike price, and if see how here, if you bought a 315 put when it was at 336, it would have got all the way down to 299, and that would have been some good money that you made off them puts. And then once it start coming back up, you can, like right here would have been a good spot to get back out, or even when it was like here somewhat, like in between here, that would be like, okay, I'm gonna go ahead and close this put out now because it done pulled way back. You close that put out, take them profits, and the profits that you made from closing out these calls back here, these short-term calls right here, and then you put that money from those puts and them short-term calls into a new 2-year position further down the road. That's how you use puts as defense. Any questions on that before I go to the last question? Any questions going once? Any questions going twice? Any questions going?
I raised my hand.
Oh, my bad.
Look at you. Okay,
I see it. I see it. I see it. Okay, go ahead. Go ahead. Put your hand down and then go ahead and ask your question.
Okay, wait a minute.
I already lowered it for you. Go ahead. Ask your question.
My question is, okay, I had a question about the puts and the calls, and you just touched on basically the whole thing. But my question regarding what you said, is a put and a call the same thing?
They're both contracts. They're both contracts, but the put just means you got a bearish take on the thing, meaning you think the price gonna decrease, and a call is you got a bullish thing, you think the price gonna increase.
Okay. Now in the next, we got calls. Okay, so my next question, you know how you just showed us the graph and say with the 299, that would have been a perfect time to cash, to close out if somebody had a put in the call going on. What you mean 299? What? I don't.
This is the price of the asset. Let me go back to sharing my screen. Okay, when you look at, okay, can y'all see the chart? When you look at the can you see the chart? Yes, no, maybe so.
Yeah, I see it. I see it.
All right. So I got it on a line chart right there just for visibility. This line chart is the price of the asset, not the price of the put contract. That you ain't worrying about the price of the put contract at this point, right? You just know the asset is like, see how every time it get the cooking hot up here by the top of the Bollinger Bands, it pulled back down toward this 20-day moving average. You know what I'm saying? Whenever it get to cooking hot. And so now, this time frame right here, this is the time frame when this is known to pull back, because this is from February to March. So it's known for this asset. If we was to look this asset up and what's the name? It's probably gonna say that's a time for it to pull back. Boom. See, February, it typically end like down. It's a negative nothing, but it typically end lower in February than it opened, and then in what's name, it end down like -9%. It end higher than it opened, but it's like -9%. So from February and March, seasonally QQQ pulls back. And if we go over here and we got February and we go over to March right here, you see February, it started running up and then it started pulling back. And then by the time you got to the middle of March, it had them pulled way down to here. So this stayed true to the seasonality, where in February, toward the middle of February, this is when you would have started buying your puts somewhere around here or here, when it went to cooking hot to the top of the Bollinger Bands. And then you would have rolled it all the way down. Like here, you would have got a pump fake. If you'd have took the thing off here, that would have been a good thing, but it would have bounced up. It would have been a dead cat bounce. Boink, come up, then come right back down on you. That's why you want to make sure it's still running back up. You don't want to take that put off too early. You want to make sure it is going up and you ain't just catching a dead cat bounce. Whenever an asset is pulling back for the first time, that first bounce typically don't be a real bounce. It'll pull back again most of the time. But you just got to play it by ear. That's when it comes to playing it by ear. But you selling them puts when it get all the way down to either the support level you want it, or when it get to undercooking on the Bollinger Bands, because it's going to start to come back up. And if it's outside that seasonality window, more than likely it's going to start to run again.
Okay.
Did I
yeah, you did.
Okay.
Yeah, but I just still got to learn how to read these charts and these candlesticks and stuff. That's what I got to get. I got to be like you.
Nah, you don't be like me. You want to be better than me.
Now, can I ask my question, or you got another question?
The only one I got, the last one I got is like, when should I sell? And when should you sell is that's a part of your investing plan. Before you invest in anything, you should know the price you want to get in and the price you want to get out. You can do it when you know the price you're getting in, and you can do the price going out, or you can do the percentage going out. If you want to make $50, you sell at $50. If you want to make 100%, you sell at 100%. You should know when you're coming in and when you're going out before you even make the purchase. And those are all the questions that I had for the gunshot people. So now go ahead with your question.
Okay, so now tell me what's the difference in a 150 pack versus a 170 pack? Like, I don't understand that terminology.
Okay, packs don't exist, but 150 strikes and 170 strikes. Okay, so looking at, okay, let me see. Let me see if I could pull up XLF. I don't know how to change it on here. How do I change it on this, right? Okay, we're just gonna use QQQ because I don't know how to change it on Yahoo Finance. How do I change it? Okay, let me try this right here. XLK. Boom, there you go. Let me share my screen. All right. Share. All right, so what that means, right? This is the price of the asset. You see right here where it say $150 over here to the right where I'm moving.
Yeah.
That $150, that's your 150 strike. You're saying if you're looking at a January 2023 150 strike, you're saying I want the option to buy 100 shares of XLK at $150 in January 2023. And your take is that it's going to go from 132 up to 150 before January 2023 or by January 2023. The 170 strikes, you're saying, I think it's going to get to 170 by January 2023. So the strike price is the price that you think the asset gonna get to on the put side and the call side. If you buy a 110 strike, you saying it's gonna fall to 110. If you buy a 140 strike, you saying it's gonna go up to 140.
Okay. All right. Thank you very much.
You're very welcome. Any other questions? We got about 5 more minutes.
Wait, here I go.
Okay.
Okay, well, you see it say the stock charts, right? And you have options on one side, the option chain, and it got call, strike price, put. Then you got delta, mid, bid, ask, and then that's on the call side. And then on the put side, it's reverse. I think it's bid, ask, mid, delta. Why that happen?
Well, they the same thing, except for it's just on the going up and going down side. One side to be negative and one side to be positive. Like you have positive delta on the put side, and you got negative delta on the call side.
Oh,
yeah.
Okay.
And it's just that's the probability. Delta is just the probability that it's going to end in the money, and that you can use that to roughly guesstimate how much your option price going to increase with every dollar move of your asset. So if you got a negative 40 delta, for every dollar XLK go up, your option should increase 40 cents in value for every dollar that it moved. And then the gamma is the volatility of the delta. So it's like every dollar move, you add that point whatever to that 40, and it's like the delta is always increasing. So the closer you get to your strike, the more the delta going to increase. That's why I say when you first do it, you can use it as a guesstimate of where you should land when you hit your strike price or when you hit your target thing. And but the delta, the gamma, the vega, and the theta, those are all the Greeks. The theta is the time decay. The gamma is the volatility of the delta. The delta is like the likelihood of hitting, expiring in the money or out the money, and the vega is the implied volatility of the thing. You can, and if you go to it's a real good free class on tastytrade.com, and they go through everything about options, and they break down all them deltas really good. They break them and I mean all the Greeks really good. They break it down, and I only focus on delta, gamma, and theta. Them the only ones I worry about.
Okay, so go to Tasty Trade and get a real schooling on.
Yeah, tastytrade.com and go like they learning, and
Yeah.
they got it's an options course, and they go through, they break down all the deltas, and I mean all the Greeks about the options.
Okay, I'm gonna be a smart gal when I finish this here stuff.
You right. We're gonna build a new Wakanda. That's what we're doing.
Thank you very much, Junebug.
Any
I
other
think
questions?
that's it for me. I think that's it for me. Really.
I got a question.
I want to understand those.
Okay.
When you go into your when I go into my ally account and it shows how much money I have versus how much I have spending, why does the amount in the account show more than my available balance as far as spending?
Your total value is like how much your positions is worth plus how much your cash is worth. And so like your cash is your buying power. Like when you see something say buying power, like unless like if you don't have a margin account, so your buying power is just going to be how much cash you got in there. And then your total account value is how much your position is worth plus the cash.
So like if we like say if the money, say if we go up high and we have an increase and we're in the green and we making money, our account value gonna be more than our spending power if we ain't add no more money to that. That what you mean?
Yes. Like if you just say if you put $1,000 in there and you buy a position for $800 and it don't do nothing, your account value gonna be 1,000. If your position go up $200, then your account value will be $1,200 because it's $1,000 and then it's two. And if it go down $200, your account value will be $800 because it'll be $600 plus the $200 in cash.
Gotcha. Okay. At least I was reading that right. Okay. Thank you.
All right. Questions. I don't see no hands.
Still a lot to learn, but at least I'm understanding it better and better.
Yeah. That foreign language gonna start making
some of it make a little sense, but boy, I'm gonna be so y'all ain't gonna be able to call me slow no more.
Girl, you gonna stay slow. Don't go there. You know you slow.
All right. I think we covered it all. Everybody good on the questions that I had from the inboxes?
Yep, I did.
Yep.
Well, Junebug.
Yes.
When you talking, it makes so much sense. But when we sign off,
that's why you go back and rewatch it. Just rewatch it. You'll hear me saying it all over again.
Well, as always, great job. You know you did a great job.
About to give me a headache.
I know, right?
Well, Punky, you ain't got to worry about it, baby. We got you. You good. We got you. We just thank you for tuning in. You ain't got to worry about this.
I'm learning though. I'm learning.
I'm glad I'm kin to your mama.
I am learning though.
And one bonus thing I throw in there before I wrap up, I got a couple minutes. If you got kids that's under the age of 18, they can't legally open an investment account, brokerage account by themselves, but you can open either a UTMA or a UGMA. and it's like UTMA or UGMA. It's like I think it's called like Uniform Gifting Minor Act and Uniform Transfer Minor Act. I believe that's the name of it, if I'm mistaken. And the difference is in the UTMA with a T, you can only put like stocks and bonds and stuff like that in there. And with the UGMA with a G, I believe you can put like property, you can put art and anything of value into those, but you can open up, oh, you got like a 529, which is, I think it's related to school some kind of way. I ain't want to fool with that. I did a UTMA for my boys, and then you be a custodian of that account until they hit the age of either 18 or 21, and then the account belongs to them, and you legally you can't do nothing with it no more. It belongs to them. A lot of people don't like to use those because they think their kids gonna squander it when they get older. But I'm like, hey, if you raise them right, they're gonna do the right thing. And if they don't, they grown now, it's their choice. So if you want to invest for your kids, I recommend starting now for your kids. I use a MA for mine. You can research if you want to do a 529 UTMA, UGMA. Just research it and start now for your kids, because time in the market is the most important thing. Like, I got my boys' their accounts. I showed them the amount of money they had in theirs now, and it blew their mind. And I said, wait till y'all get 30, because investing now and that compound interest over time is invaluable. It's invaluable.
So what do we do about tax for them?
And that's the thing of it, is that it's like, it's gonna be on them. It's gonna be the taxes in the future. You see what I'm saying? It's like it's gonna be their future taxes.
So underage don't have to really worry about tax until they take over, and then they have to deal with it.
Yes, unless you cash it out. If you cash the positions out, then it's like tax. But again, I'm not a financial advisor. But if you ain't cashing it out and you just buying it and you holding it, the tax implications come in, like, because we're banking on the future taxes is going to be less than our taxes, or whatever, but they got the money to be able to pay them taxes on the money. Because I feel like, hey, I'd rather invest and give Uncle Sugar his money and make money than to sit back and put it in the bank and get 0.005% on my money. Okay, so then I guess I could round that up to saying the tax is due when you cash it out. Yeah. On the gains, just like with a Roth IRA, it's like your taxes due on the gains. Like you don't get taxed on what you put in, but you got to pay taxes on the gains. So it's like, if you start pulling money out of a Roth, if you pulling at your contributions, you don't have to pay taxes on it. But if you pulling at your gains, you get taxed on them gains. But it's like future taxes. You see what I'm saying? It's like Uncle Sugar gonna get his money. But for like kids, I just say start now, because if you start now, if you go look up like a investment calculator and put in, just say you start them with $2,000 and you're gonna add $50 a month, and then do it over 30 years, and you will be surprised at how much money that'll be. And it be based off, you can base it off of like a small low end return of like 7%, and it'd be like close to $1 million after 30 years. You know what I'm saying? So that's why I'd be like, and 7% is real conservative. Yeah.
Thank you.
Okay, dope. I think I got about a minute and a half, so I'm gonna go ahead and wrap it up. As always, thank y'all for tuning in. This has been the last Tim's Tidbits on our investing journey. Go back and rewatch them. Look at all these Tim Tidbits. Look at the Come Up Series Starter Pack. Go to EYL YouTube page. Look at all the Market Mondays. Go to Tasty Trades. Look up the options class. Do your research. Put your money in the market, because, man, this changing lives. And for everybody who don't know, I'm going to early retirement on April 30th, y'all. They done let me figure I can do this. My sweetie co-signed on it. 4:30, my last day at work, baby. But yeah, man, thank y'all for tuning in. As always, y'all know what it is. I'm gone.